we're jumping straight into Webull Corporation today.
Right.
And everyone is watching the stock price jump around. The daily volatility can be really distracting.
Oh, absolutely. That noise often hides what's really going on.
But the real story here is it's much deeper than just those short-term moves. It's this dramatic financial turnaround they pulled off in the third quarter of 2025.
And that turnaround, combined with their aggressive geographic expansion, that's what really positions the company for, sustained growth.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
If you're enjoying the show, make sure to subscribe and hit the like button. It really helps the channel.
And definitely let us know in the comments which stock you want us to simplify next.
All right, let's look at the bull and bear case for Webull Corporation right now.
Okay, so let's start with that turnaround. Why is Webull fundamentally different now than it was, say, 12 months ago?
It all comes down to that Q3 2025 report. It was a critical inflection point.
Crucial is, I think, an understatement.
Yeah.
I mean, for context, they were losing money the prior year.
Mm-hmm.
Now they're reporting a net income of $36.9 million.
It's not just a lucky quarter. That's a massive fundamental swing into profitability.
And it tells you that the underlying economics of their model are sound.
Exactly. Especially as they're pushing into new international markets. For investors, this signals sustainable operating leverage.
Meaning for every new dollar of revenue, more of it is just flowing straight to the bottom line.
Because their cost structure is finally under control, it completely de-risks the whole global growth story.
But the shift wasn't just driven by cutting costs, right? It was propelled by this incredible top-line momentum.
Absolutely.
Revenue accelerated to 55% year over year. It hit $156.9 million.
And when you see that kind of velocity, you have to ask, is this just a temporary thing or is it a real competitive advantage?
So you have to dissect that revenue.
You do. And trading-related revenue surged even faster, up 64% year over year.
Okay.
That tells me this isn't just the market lifting all boats. It shows, really elevated user engagement. People are actively choosing Webull.
And that activity has translated directly into sticky money on the platform. Let's talk about customer assets.
Which expanded dramatically.
Up 84% year over year, hitting $21.2 billion. That's a huge vote of confidence.
It really is. I mean, an 84% asset growth tells you two things. First, they're getting strong net deposits, so people are actively moving their money there.
And second.
And maybe more importantly, they are retaining users and growing their, quote, share of wallet.
So it's not just for speculative trades anymore. People are housing their long-term money there.
That changes the risk profile completely.
And the margins back that up. The adjusted operating margin expanded to 28.7%.
Now, compare that to their expense growth,
which was only 18% year over year.
That's the definition of disciplined scaling right there. They are squeezing more efficiency out while still fueling that massive 55% revenue growth.
That discipline lets them build just a tremendous financial cushion.
Which is essential if you're trying to pull off an aggressive global land grab.
No question. The company holds $1.8 billion in cash and cash equivalents.
So they have the liquidity to manage risk and, more importantly, to fuel this expansion we're talking about.
And on top of that, their capital structure is incredibly conservative.
It's almost boringly conservative, which is actually a really good thing for a growth company.
They have a low debt-to-equity ratio of 10%.
And for you, the learner, that 10% D&E ratio means they have a huge capacity to raise debt quickly and cheaply if they need to.
So if they see a smaller competitor to acquire or some tech they want to license?
They have a massive war chest, and they can finance it without stressing their core balance sheet at all.
So with that financial stability, they can finally pivot fully to building their competitive moat?
It does. I mean, that's the foundation for their core advantage.
Yeah.
The all-in-one platform differentiation.
Right. They're not just another stock trading app.
No. They're consolidating everything. Equities, options, crypto, even corporate bonds, all tailored for that active, self-directed trader.
The person who needs speed and breadth.
Exactly.
And this is where the future growth gets really interesting, right? The innovation pipeline.
Yeah. Webull is investing heavily in next-gen tools.
Right.
You have to look at the Vega AI initiative and the U.S. crypto relaunch specifically.
So the Vega AI, what's so critical about that? I mean, every fintech talks about AI.
True. But Webull is using it less for, generalized customer service and more to streamline the complex regulatory stuff they have to deal with globally.
Oh, okay.
And management is signaling that the early adoption of these projects is highly positive. It's an investment in platform stickiness.
And why did they need to relaunch crypto in the US? What makes it different this time?
It's all about creating a unified, compliant, and more efficient experience that lines up with the new U.S. rules.
So maximizing revenue while minimizing risk.
Pure and simple. It's revenue diversification.
And beyond the product, they're building this geographic moat, the international expansion. It's not random. It's very systematic.
Absolutely. They just launched the consolidated Webull app in Latin America, so key markets like Brazil and Mexico.
And they've announced they're moving into Europe.
Right. And if you connect the dots, this isn't just about finding new customers. It's about creating a multi-jurisdictional defense system.
It reduces their reliance on any single market.
Exactly. Especially their reliance on the U.S. regulatory environment, which, as we know, carries a pretty significant overhang.
That structural de-risking is key. So if we look at the near term, say the next 3 months, what are the specific events you should be watching?
January 2026 is critical. That's the Q4 2025 earnings release.
And expectations are high.
Very high, driven by that strong Q3 and, typically higher holiday trading volumes. Any slight miss on revenue or margin could spook the market. You also need to watch the ramp up in Europe. Are they hitting their timelines? And any announcements about institutional adoption or custody partnerships, that would be a huge legitimizing factor.
Speaking of momentum, let's touch on the technicals for a minute. We're seeing a genuine bullish reversal here.
It really is. It bounced cleanly off those recent 12-month lows, around $7.57.
And now it's trading decisively above its 50-day moving average.
And after that strong earnings report, momentum indicators, like the MACD, showed a clear bullish crossover.
So for the less technically inclined, that basically means the short-term momentum has finally overtaken the long-term bearishness.
It does. It suggests that institutional players are starting to come in based on the conviction of those Q3 numbers. The fundamentals are finally backing up the chart.
Okay, now, we cannot talk about a high-growth fintech executing a global strategy without honestly discussing the risks.
You have to have a balanced view.
And the core risks here kind of split between company-specific operational challenges and then these broader sector-wide headwinds.
Let's start with the biggest operational risk, the volume dependency trap.
Meaning their success is tied to high transaction volumes.
Intrinsically tied. Their revenue is heavily dependent on trading-related income.
So what happens if the market just goes quiet?
If we hit a long period of market calm or a big slowdown in retail trading activity, which is historically very cyclical, it could significantly impact their revenue.
So, for example, if retail trading volume dropped, say 50% year over year.
Well, achieving that $36.9 million in net income becomes extraordinarily difficult. The business is built to scale in high-volume markets, and a drought can expose vulnerabilities very quickly.
And while they've shown good cost management, that 18% expense growth is solid, they have to stay extremely disciplined as they scale globally.
And global scaling is inherently expensive.
Very expensive. I mean, especially in tech and compliance. They have to launch in Europe, Latin America. That means new regulators, new data centers, local staff, new banking partners.
It's a massive upfront capital cost that won't immediately bring in revenue. Any slip-up in forecasting those expenses could easily erase their margin gains.
And there's a specific financial vulnerability we have to mention. The book value per share is still negative.
That's a key marker of valuation risk. It means that theoretically, if you liquidate all their assets and pay off all their liabilities, you're left with a deficit.
Now, that's pretty common for high-growth tech firms.
It is, but it highlights a stark reality. In a severe downturn where sentiment collapses, this company is exposed to an inherent valuation risk that, say, an established bank might not face.
This brings up an even bigger question. What about the structural threat that affects the entire retail brokerage industry?
You mean the regulatory overhang?
Specifically, payment for order flow, or PFOF.
Right. Their whole business model relies heavily on that trading-related income. And a big part of that is PFOF.
And there's always talk in political circles about banning or restricting it.
It's a recurring threat. And any rule changes could materially impact their margin profile, basically overnight. It's the biggest structural overhang on the entire sector.
So if that revenue source gets capped or banned, what are their options?
They'd have two choices, really. Either start charging commissions, which could cost them market share, or just absorb the loss, which would directly compress those impressive operating margins we just talked about.
But they are actively trying to mitigate this specific risk, correct?
Mhm.
Through that international expansion.
Absolutely. And that is the key mitigation strategy. It's actually kind of genius if it works.
How so?
By building up strong revenue bases in Latin America and Europe, where PFOF rules might be different or less restrictive, they're de-risking the business.
They're making themselves less correlated to U.S. market cycles and, crucially, U.S. PFOF policy.
Exactly. If their revenue from these new markets becomes substantial enough, the impact of a U.S. PFOF ban becomes proportionally less severe.
So, to sum up the external factors, market slowdowns can hurt volumes, but their global reach and diversified products, equities, crypto, bonds, offer some resilience that other domestic-focused platforms just don't have.
So to wrap up, Webull Corporation has definitively hit a crucial financial inflection point.
Yeah.
They've proven that profitability and high growth are not, for them, right now, mutually exclusive.
They're aggressively pursuing this global AI-driven strategy.
And that combination of accelerating profitability and high customer asset growth, that provides a really strong, durable foundation. The two key variables going forward are going to be execution on that global plan and how they navigate that persistent PFOF risk.
That's the lowdown on Webull Corporation for today. If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.
Before we go, let's leave you with this thought to mull over.
Think about the sheer complexity of running a zero-fee trading platform across multiple continents.
The challenge isn't just getting customers. It's keeping the platform uniform and maintaining operating leverage while managing these radically different, incredibly complex regulatory regimes in every single country.
So the question is Webull Corporation's ability to handle this international regulatory complexity their ultimate, most durable competitive advantage?